Intermediate Accounting, Chapter 12, Appendix. Chapter 12, Intangible Assets and Goodwill. After studying Appendix 12A, you should be able to 11. Explain and imply basic approaches to valuing goodwill. Appendix 12A, Valuing Goodwill. When one entity acquires 100% of another business, there is the potential of goodwill. Goodwill is equal to the excess of the fair value of the consideration given up by the acquirer over the fair value of the identifiable assets acquired and liabilities assumed in the business acquisition. Appendix 12A, Valuing Goodwill Excess Earnings Approach. One method used to estimate the amount of goodwill in a business is the excess earnings approach. This is a systematic and logical way to calculate goodwill because its value is directly related to what makes a company worth more than the sum of its parts. The steps in the excess earnings approach to estimating goodwill will be demonstrated on the next slides. Appendix 12A, Valuing Goodwill, Excess Earnings Approach Example. Company B is considering purchasing Company A, so they are calculating the goodwill in Company A. The earnings history for Company A from 2015 to 2019 total $375,000, and the average earnings is about $75,000. In 2017, there was a gain on discontinued operations of $25,000 as well. So the fair value of Company A's identifiable assets is $350,000. Company A, statement at financial position December 31st, 2020, had cash, accounts receivable, inventory, property, plant, and equipment, and current liabilities at the amounts disclosed. Adjustments for differences in accounting policies. Company A inventory was average cost and Company B was FIFO, so there's an adjustment for $2,000. Depreciation, Company A was accelerated and Company B had straight line, and so there was an adjustment for $3,000. Adjustments for non-recurring items, which is the gain on the discontinued operations, amortized, is $5,000. And the adjustment for unrecorded assets, where there was a patent for $18,000 and amortization of $1,000. Appendix 12A, Valuing Goodwill, Excess Earnings Approach, Example 2 of 5. Calculate the average annual normalized earnings the company is expected to earn in the future. So the average past earnings was $75,000. We adjusted the change from average cost of FIFO for $2,000 and the change from accelerated straight line depreciation, and that is $3,000. So then we have a total of $80,000. Then we're going to subtract the amortization on the discontinued operations gain and also the patent amortization on a straight line basis. So that's $6,000. So the expected future annual earnings of Tractorling is $74,000. Appendix 12A, Valuing Goodwill, Excess Earnings Approach, Example 3 of 5. 2. Calculate the average earnings that the company would be expected to earn if it generated the same return on investment as the average firm in the same industry. So fair value of Company A's identifiable net assets is $350,000. The industry average rate of return is $15,000. So Company A's earnings with no goodwill would be $52,500. And we're assuming a rate of 15%, and we found that to be the average in Company A's industry. Appendix 12A, Valuing Goodwill, Excess Earnings Approach, Example 4 of 5. 3. Calculate the excess annual earnings, the difference between what the specific company and the average firm in the industry are expected to earn in the future. So the expected future earnings of Company A was $74,000. Company A's earnings with no goodwill would be $52,500. So Company A's excess annual earnings is $21,500. Appendix 12A, Valuing Goodwill, Excess Earnings Approach Example 5 of 5. 4. Estimate the value of the goodwill based on the future stream of excess earnings. To find the present value of future earnings, a discount rate must be chosen, as well as the length of the discount period. Choice of discount rate is very subjective. Present value is negatively correlated with the discount rate. Goodwill, if capitalized at 25%, would be excess earnings of $21,500 and the capitalization rate of 25% to give us $86,000. This is the amount that a purchaser should be willing to pay above the fair value of the identifiable net assets, that is for goodwill. And the goodwill, if capitalized at 15%, would be $143,333. Goodwill is assumed to be indefinite, whereas excess earnings are assumed to last for a limited number of years. Appendix 12A, Valuing Goodwill, Total Earnings Approach. Under the total earnings approach, the value of the company as a whole is determined based on the total expected earnings, not just the excess earnings. The fair value of the identifiable net assets is then deducted from the value of the company as a whole. The difference is goodwill. Appendix 12A, Valuing Goodwill, Total Earnings Approach Example. So we have the same information and the discount period is in perpetuity, meaning it goes on forever. So the fair value of the company is the present value of the annuity of the future earnings. So that would be the present value of the annuity of $74,000 at 15%, and that gives us $493,333. And then we have the fair value of identifiable net assets. That equals the present value of the annuity of industry level earnings. So the present value of the annuity of $52,500 divided by the 15% would be $350,000. So then the goodwill will be $143,333. Appendix 12A, Valuing Goodwill, Other Valuation Methods. Number of years method. Excess earnings, X number of years of expected excess earnings, provides a rough measure of goodwill, simple to calculate, does not consider the time value of money. Discounted free cash flow method. Projects the company's free cash flow over a long period, typically 10 or 20 years. Objective is to determine the operating cash flow that will be generated beyond the amount needed to maintain existing capacity. Present value of the free cash flow represents the value of the business.